Very good, you guys. Thank you for waiting. Next presenters, and the last one today, are from Fentura Financial. Is that right? The right
Correct.
name. Okay. We have Ron Justice with us here, the CEO, and Aaron Worsling, who's the CFO. Ventura is a very high performing Michigan franchise, over 1.7 billion in assets, and a track record of very highly shareholder friendly, and pragmatic, I would say, actions, which we'll hear more about in a moment. So thank you very much for being here. I'm going to start sharing my screen, okay, and then we'll come back on for the Q&A, and I'll mute myself.
Sounds great. You're all set then? Well, first, good afternoon, and I want to thank Ian and Julianne for the opportunity to present this afternoon. As indicated, my name is Ronald Justice. I'm the president and CEO of Fentura Financial, Inc. and its subsidiary bank, the State Bank. The company and the bank are headquartered in Fenton, Michigan, which is located in Genesee County, approximately 50 miles north and a little bit west of Detroit. We celebrated our 125th anniversary at the bank in September of this year, and certainly are proud of our long history and our legacy to the markets that we serve. As Julianne noted, we are a $1.7 billion community bank whose balance sheet focuses on real estate lending on the asset side, commercial real estate lending, and traditional banking products delivered through brick and mortar, as well as an up-to-date digital platform on the retail side, in addition to the strong treasury management business line. We are the 10th largest community bank in the state of Michigan. We have been named the #1 community bank SBA lender in Michigan for several years running, and we've been named to American Banker Magazine's top 200 publicly traded community banks under $2 billion in assets since 2019, based on ROE. The slide that is displayed now highlights a number of key performance indicators that our CFO, Aaron Worsling, will highlight in just a few moments. The next two slides provide detail regarding the market share of financial institutions in the counties that we serve. We operate in 8 Michigan counties. We operate in the two top highest counties for average household income, that being Livingston and Oakland County. Additionally, we operate in 3 of the top 10 MSAs, that being Saginaw, Bay City, and Flint. We have 20 branch locations and 2 loan production offices that are dispersed throughout our footprint. Just a couple of comments about Michigan economic factors. The housing industry in Michigan is showing resilience and a bit of growth. Michigan housing prices are up 2.5% over the prior year as of September month end. Michigan homes average about 8 days on the market from listing to pending during that same period. And during that same period, 51.3% of the homes in Michigan sold over list price. We operate in or adjacent to 5 of the 10 top Michigan metros, in which housing growth rates are significantly above the Michigan average over the last year, again, through September. I wanted to talk about governance briefly to provide some insight into this year's proxy statement. The company included a shareholder proposal in our proxy, wherein the board, consistent with its fiduciary responsibilities, committed to its efforts to continue to evaluate all strategic alternatives that could enhance shareholder value. Accordingly, throughout the year, as in previous years, we used outside sources, primarily investment bankers, to analyze strategic alternatives and review them with the board and management for their consideration. This process will continue as we move forward. These alternatives include further acquisitions, bank or branches, as the company did acquire a bank in both 2016 and in 2021, organic expansion into new markets, and sale and merger opportunities. These analyses have included consideration of all types of financial institution partners. Additionally, this year's proxy included a director nominee that was submitted by a shareholder. After interviewing this nominee, the board felt strongly that this candidate would be a productive director, and accordingly, he was placed on our ballot and was appointed to the board. His first meeting was in June of this year. So hopefully that provides a bit of insight to and maybe a bit of clarity for some who have perhaps reviewed our annual meeting materials. So at this point, I want to turn it over to our CFO, Aaron Worsing, to highlight some important company financial performance.
Thanks, Ron. The first thing that I just wanted to point out and share with the current and potential investors is that our organizational model for the recent past, and I would say which would be the last decade, has really been focused on strong organic growth in both loans and deposits. At first, I think when you look at some of the levels of growth that we've seen the last few years, it'd be easy to assume that it has been acquisition based, especially as Michigan as a whole. While Ron mentioned, the housing values have gone up, it's not what would be considered a high growth market as a whole. So just since 2019, we've doubled in asset size, and included in that was one acquisition of a small financial institution, which again added around $100 million in assets, which is all. And so again, our lending teams have been very successful in growing our primarily real estate portfolios, which Ron mentioned. And really one of the primary strategies when we approach these opportunities is to focus credit first, and then sometimes take a little bit less from a rate perspective to have stronger credit. As based on the team that we have in place, we have ample opportunities to grow the portfolio. So based on the small risk premiums that are out there, we felt it has been more advantageous, again, as I mentioned, to grow with higher quality and potentially slightly lower yields than take on additional credit risk. And then switching over to the deposit side, our retail deposit team has done a phenomenal job of growing a strong deposit franchise. Again, as Ron mentioned, we've been around for 125 years. But I also think it's important, to keep in mind that while we are a primarily real estate and significantly commercial real estate focused institution, 30% of our deposit base continues to be in non-interest bearing deposit accounts. Now that has trended down from 36% a year ago, but overall, based on the mix of our loan portfolio and specifically our commercial loan portfolio, we look at that as a very strong metrics, and that stacks up very well against our peers. And then additionally, when we look at the deposit growth, and again, most of that is in true organic loan growth, we have consistently outperformed state of Michigan as well as averages, as well as the counties that we serve. And to quantify that, over the last 5 and 10 years, we have exceeded the average state of Michigan deposit growth by over 200%. So again, our team is doing twice what the market is from a growth perspective. And that historically has not been driven by paying higher than necessary market rates. Now, of course, that has changed in the last year, but again, that is not unique to us. Talking about credit quality metrics, our credit quality metrics remain very strong and at or near historically low levels. We have seen a few deals here and there creep in to get looked at from a non-accrual perspective, but I will say that we continue to look every quarter. We stress test the loan portfolio to look for cracks, and we are not seeing any systemic issues in any of our portfolio segments or the geographies that we serve. Any credit issues that have come up, which again have been few and far between, are very unique circumstances that, again, we encourage our team, in fact, require our teams to go in and determine, are there bigger issues here? And we are really just not finding them. Additionally, again, as we mentioned multiple times, not just only are we a real estate focused institution, but we are highly focused on commercial real estate. And that is not something that we hide from, but that is the strong quality of the teams that we have in place. Well, we have worked to expand our C&I portfolios from both a diversification perspective as well as a deposit generation perspective. We continue to be primarily focused on commercial real estate. That being said, when we look at the level of diversification in our commercial real estate portfolio, it is very well diversified. And while we do have a regulatory CRE concentration as of the end of September of around 390% of capital, we have very limited exposure to office, very limited exposure to recreational properties. In fact, if you were to look at our earnings release, which again I will tell you contains a significant amount of very detailed information about the bank, about the operating segments, our exposure to office of non-owner occupied was $63 million as of the end of September. And that has maintained a relatively stable balance over time. So again, you would see that we are not highly concentrated into any one particular sector from a commercial real estate exposure perspective. From a deposit mix perspective, again, as I mentioned a little bit earlier, approximately 30% of our deposit base is non-interest bearing. Now, that being said, we, like all other financial institutions, have continued to see significant pressure on both non-interest bearing accounts as well as lower interest bearing accounts. So we have seen a shift out of savings accounts into higher yielding money market accounts, CDs to a lesser extent. So we have continued to see a impactful level of disintermediation between the deposit portfolio. But I will say that we actively manage, monitor, and most importantly, communicate with our larger and largest deposit customers on a regular basis. Our treasury management teams are very active in reaching out to their contacts and make sure that we are cognizant of current market conditions as well as investor expectations as it relates to the deposit side of the balance sheet. We have not offered any, I guess I would say, market leading rates as it relates to deposits from a standard perspective. Now, that being said, we are, like many other financial institutions, pricing deposits on a one-off basis, as is very common based on the environment right now, which again leads us into net interest margin trends. We, like other institutions, have seen meaningful pressure on our net interest margins. I know that probably the question we would all love to have answered today would be is when are they going to bottom? And I know that there could be discussion of what inning are we in, and we are getting close to the end based on what we know today. But I'm not yet confident in being able to say if they're going to bottom out in the fourth quarter or in the first quarter of next year, as there are just a significant amount of unknowns in terms of fiscal policy, but just coupled with just current demand for overall markets or overall deposits in the markets that we serve, in addition to the very strong credit union presence that operates within Michigan as a whole, and also very specifically in the markets that we actively serve. To help supplement some of the pressure that we are seeing from net interest margin compression, we are actively looking to find ways to expand non-interest income. Non-interest income, one of the largest drivers in that has traditionally been our mortgage banking business, as we have been a large originator and seller to the secondary market of mortgage loans. And of course, as that business has died down, we've looked for ways to replace the income. And I would say, effectively into 2023 and really looking forward into 2024 and beyond, we are actively looking to expand the trust and wealth management portfolios to help drive that, as that provides opportunities for unlimited growth, as it does not require capital to fund the growth. But then additionally, to look at maybe less frequent ways to supplement earnings, like looking at SBA loan sales. Again, as Ron mentioned, we have been a very strong originator of SBA loans, but historically we have kept the guaranteed portion of the loans on our balance sheet rather than selling them off. And that was because historically we have had significant excess market-based funding at low cost. So I think as we continue to battle a high interest rate environment into 2023, we are actively looking to sell some of those guarantees based on the originations that we are seeing right now. And then from a non-interest expense strategies, I guess I would say that we have had significant discussions, and more significant discussions than we've had since I've started here, about looking at finding ways to create more variability on the expense side of our income statement. And part of that is we will continue to see reductions in compensation, specifically as it relates to the incentives paid to both our commercial and our residential mortgage origination teams. Capital management, as we've talked about multiple times in this call today, we have actively been focused on growth for essentially the last decade. And because of that, we have not been a high dividend payer. We have been a consistent dividend payer for the last few years, and have maintained and increased that. We also have, in the last few years, based on very strong earnings, been able to exercise certain stock buybacks. We currently have, of our $10 million authorization, $1.4 million left available to repurchase should the market conditions dictate, as well as capital preservation needs come into play as well. Now, I would say that when we start to look into 2024, based on our increasing level of capital ratios, getting back to where we want them to be, we are going to start to have more active discussions about, is it time to do stock buybacks? Is it time to look at our dividend strategy? Not to say that we are going to necessarily change that, but based on where we are today from an overall capital perspective, we want to build in a larger buffer than what we have. Stock performance, one of the benefits to being an OTCQX bank this year, I think for us is we have not had as much of volatility as some of our NASDAQ peers. In fact, we have significantly outperformed the overwhelming majority of our peers for the year-to-date, 1 year, 5 year, and 10-year horizon. So again, very, very happy of the returns there. So I guess at this point in time, I can turn back to Ron, or we can open up for some questions.
No, Aaron, thank you. Nice job. And I think we are ready for any questions that there may be.
Great. Yes, thank you. Very impressive. I just wanted to, give credit where credit's due. That that you had the shareholder proposal, and regardless of how many shares he owned or represented, you took it seriously, and put one and even consider two, I believe, new board members, which I think says a lot about your being shareholder responsive, because your numbers are relatively strong. Your history has been strong, and even your current numbers are strong on a relative basis as far as profitability goes, and your deposit franchise. And so I applaud that.
Thank you.
Yeah. And let's see, you mentioned that you hired at least one investment bank to look at all kinds of opportunities. And I was curious about your M&A history because you've actually sold two banks in your past, and which I remember I missed because I just don't see that very often, and so I didn't even look at that column when I was looking at the transactions. Can you describe how it came to be that you sold two banks, and and did you make good money off of that? I was just wondering.
Yes, sure. So we have sold to financial institutions in the past. At one point in time, we were a three-bank holding company, basically as we moved through the early 2000s. We had a branch operation that was about 25 miles from our headquarters that we thought we could identify key directors in the communities that were surrounding that branch location and grow it faster, exponentially faster than if it just had remained a branch alone. And so we did create a separate charter, created a bank, and operated from, again, that bank in particular from about 2000 forward. I think we actually opened it, in like maybe perhaps 1999, but operated through the early 2000s. And then in 2000, I believe in 2003, we had purchased a bank on the west side of the state, and we operated that bank successfully for a number of years as well. When we entered the Great Recession, and we started seeing pressures across our footprint and across the state, we did some internal assessment and analysis and decided that we wanted to focus our energies and our efforts on the lead bank, the state bank that continues to survive. So over about a 1.5 year period of time, we sold first the bank that we developed organically from a branch location, and then 2 years later sold the bank that was in West Michigan. And again, given the timeline of when we were looking at these sales, it was more strategic in nature to be able to take our resources, including capital, and direct it towards the lead bank.
And did you make much money off of those two sales?
Again, more strategic in nature, so they weren't
Okay.
large money generators as opposed to allowing us to preserve.
And so it was a capital reallocation.
Absolutely.
Okay.
Absolutely.
So and you've bought a couple banks too. So you've both bought and sold. And so what is you have a good perspective on the consolidation environment right now in Michigan. What are your thoughts? Is it a better time to be a buyer, better time to be a seller? What are your thoughts about that?
Well, we certainly have monitored the trends as we consider, our own strategic direction in the future and whether or not there's additional opportunities. We certainly, from a selling side, generally, if we were to consider that, or any institution in considering that, I think that a lot of emphasis has to be placed on the timing, and given where prices are today, the multiples are today, from my perspective, from a selling side, probably a more conservative time period. For just looking at the situation then as a buyer for us, again, given all of the dynamics and all of the that are going on in our operation and in our balance sheet, it would have to be, for us to be in the market as a true buyer, would have to be a relatively small institution. So again, we've identified areas to continue to strengthen our operation as we've moved throughout 2023, and we'll do the same as we budget and plan for at least 2024 and the year that follows, and the year that follows this, and then beyond, to determine when we think some of those opportunities, and to see what the economy does as far as whether or not we feel it's a stronger time for us to look for a buying opportunity.
Okay, and on the flip side, credit unions, Michigan credit unions have been very active acquirers, both in state and out of state. What are your thoughts on them as potential partners? Or I'm just curious and do they really change the dynamics for M&As, make it harder to buy somebody, easier to sell? I'm just curious.
I do think it changes the dynamics for sure. Ability to pay is different, and ability to structure deals is different than most financial institutions. As we consider our analyses, as we look at our strategic options, we have looked at all, as indicated in my comments, all financial institution partners. So that certainly is a piece of the mix. I do know that as we looked at acquiring, specifically in the acquisition that we did in 2021, we were up against, we again didn't ever hear the names of, but we knew that we were up against at least one credit union in that bid process. So I do think it changes the dynamics just on the ability to structure deals differently than maybe perhaps most financial institutions. So I guess that's my response.
Okay. Yeah. So it makes a difference,
Absolutely.
but it's right. And, it can cut both ways, right? Um, just to ask about the capital, you mentioned your CRE to cap ratio, I think just under 400%, maybe like 399. Yeah, but we're hearing about a lot higher ratios. It's in this particular time period that's not that high. I'm just curious, have the regulators, they used to throw out 300 is what we would hear. What are they talking about that cat? Clearly they're looking the other way to a certain extent, but I'm just wondering if for any color about that.
Aaron, would you or I want to respond?
It's up to you again. I mean,
Go ahead.
I would definitely say that the regulators are not looking the other way. I think that there has always been and continues to be a very strong emphasis on monitoring the portfolios once you get above the 300%. There's not a hard stop in place. And I think that, to our lending team's credit, we've been very they just receive very little criticism as it relates to the work that we're doing and all the analysis that we do, how we slice and dice the portfolio, how we stress test it, and that's really, I guess I would say, the cost of entrance into that business, if that's really where we want to be. And I think our team does a phenomenal job of tracking it. And again, I mean, it is definitely not getting a pass, but it is all in the process and how seriously that we take. Because again, I think for us, that's who we are. That's what we do. So we take it very seriously.
Do the regulators really distinguish between non-owner occupied and owner occupied, or it's not so much that as much as your underwriting, your specific underwriting, and your specific track record credit?
There's definitely a higher focus on the non-owner occupied, and it's like specifically into certain sectors. So right now, obviously, there's a huge focus in office, and then also a very high focus on major metropolitan areas based on the work from home impact on the commercial real estate. And I think that, number one, obviously our exposure to office is relatively limited, and our exposure to, while we are, I guess I would say, metropolitan Detroit adjacent, we have very little exposure into true metropolitan commercial real estate on our side. And again, I say that is well documented in both our concentration analyses as well as our discussion with our examiners.
Okay. Well, even with that, like I said, in the context of today, it's not a super high ratio, and even with that, you've got very strong capital ratios. And I know you said you have been in kind of a rebuilding mode for capital, where you're right there. You're almost right there at your target. And the stock's trading below tangible, again, on it pretty much any metric, no matter how different ways you cut it, it's below tangible book. So I hope that it's good to hear that buybacks are on the drawing board for next year, and maybe for earlier next year. than not, but I think that's great. And and then just I know it's almost time, but just real quick, it sounds like commercial real estate value trends are holding. Can you just give some color on commercial real estate values?
You want to take that as well, Aaron?
I guess I would say that commercial real estate values continue to increase. We are not seeing softening in really any of the geographies or individual market segments. And I guess I would say that, you know, while we are seeing increases in values, we have taken a very firm stance into are willing to essentially fund or lend on increases in values. So what opportunities working at, we are capping our exposure at the original purchase price. So let's just say if a customer or a potential customer purchased a property 5 years ago and it's for $2 million and now it's worth $4 million, we will finance them up to $2 million. And yes, that is only 50% loan to value based where it sits today, but that is where we end. Because there are enough deals out there to where we don't need to chase financing appreciation, which again, for us, we're not saying that the value isn't there, but we also don't want to take that level of exposure based on where we're at in the cycle right now.
Right. Okay. And then just one last quick question about the stock ownership. Are there any concentrations of ownership? Like 5%-ish owners and groups?
So based on what is known directly to us and is publicly disclosed, we do have one institutional who is over 5%. And while we did not talk about this here today, we have done 2 private placement capital raises since 2016. And in 2016 was related to the purchase of a bank. 2018 was I guess I would call it a recap to provide additional opportunity to grow. And, you know, within that, essentially, you know, the dollars that were raised in both of those capital raises were meaningfully participated in by institutional investors. Now, I don't know necessarily where all of that exposure sits today, as we do have a meaningful amount of shares that are on the OBO list. So it's hard for me to know. But again, I mean, the institutionals have, at least in the past, participated in our capital raises.
Okay. All right. So good sponsorship. Good to hear. All right. Very good. Well, is there anything else that you would like to add? Anything else that
I think just again to thank both of you, Ian and Julianne, for allowing us to present today. It's been our pleasure, and again, just very, very appreciative.
Well, thank you for coming.
Thank you.
Participating. Just to remind our attendees and